Welcome to today's market report.
European stock markets traded higher on Monday, helped by strong results from banking giant HSBC and French insurer AXA, as well as healthy German retail sales. The DAX in Germany traded 0.5% higher, CAC 40 rose 0.9%, FTSE 100 climbed 1%. The quarterly earnings season has generally been positive so far in Europe, and HSBC, Europe's largest bank by assets, continued the theme on Monday. The banking giant posted pre-tax profit for the first half of the year of $10.8 billion, more than double the performance for the same period last year. It also reinstated its dividend payments and released $700 million that had been set aside to cover potential bad loans. Its stock rose 1.2%. Heineken stock slipped 0.1% after the world's second largest brewer beat first half earnings expectations, but warned of weakness in the rest of the year as costs cut into margins. The Dutch AEX index nonetheless hit a new all-time high thanks to further strength in chip-making names ASML and BE Semiconductor, and a rebound in process stock. AXA stock rose 3% after Europe's second largest insurer reported a 180% increase in net income in the first half, rebounding from last year's COVID-19 hit. There was not such good news from Allianz, its stock falling 5.4% after the German insurer and asset manager warned of a potential hit as the US Department of Justice began an investigation into its structured alpha funds. Aero engineer Meggitt stock soared 58% after US firm Packer Hannifin said it would buy the UK rival in a deal that values it at £6.3 billion. German retail sales rose 4.2% in June, much more than expected following an easing of COVID-19 restrictions, and followed an upwardly revised increase of 4.6% in May. German manufacturing PMI data also came in better than expected, rising to 65.9 in July from 65.1, which bodes well for Europe as a whole, as the German economy tends to be the region's main driver. Asian markets traded higher on Monday, creating a positive handover for Europe as Chinese equity markets stabilizes after last week's heavy sell-off on the back of the crackdown by local regulators on the tech and education sectors. The tone was helped by a call from Chinese regulators for a dialogue with their US counterparts over Chinese companies' listings in the US. Oil prices weakened on Monday in response to the Chinese factory data slowing sharply in July, suggesting weakening economic growth in the largest crude importer in the world. The US crude futures traded 1.2% lower at $73.03 per barrel. Brent contract fell 1.2% to $74.53 per barrel. Gold futures fell 0.3% to $1,811.25 per ounce. On the FX front, GBP/USD is easing off daily highs of 139.33 on the back of the UK final manufacturing PMI, which came in line with expectation. The figure was held steady at 60.4 in July, while output and new order growth eased to 4-month lows. Although July saw UK manufacturers report a further month of solid growth, scarcity of inputs, transport and labour are stifling many businesses. On one hand, manufacturers are benefiting from reopening economies. This is leading to solid inflows of new work from both domestic and overseas markets, including in the US, EU, China and the Middle East. The Bank of England Deputy Governor Broadbent, representing the middle ground of MPC, does not appear to join the more hawkish camp, marginally weighing on the near-term outlook of the GBP in the view of economists at HSBC. They continue to expect the cable to move lower over the medium to long term. Rates market pricing is already looking for rate hikes to begin in Q2 next year, as are our economists. However, the GBP appears to have moved even further in anticipating UK outperformance. This pushback against any near-term tightening, although modest, may still cause some froth to come out of the GBP. Besides the monetary policy prospects, any emergence of downside risks would also hit the GBP. Those risks could be more visible as the UK government support schemes, for example VAT and stamp duty cuts, roll off in the month ahead. The buying interest returns to the single currency euro and pushed the euro dollar back to the 118.80-90 band at the beginning of the week. The dollar index eased 0.14% to 91.98.
This is today's market news. Thanks for listening. We'll see you next time.